Joining us now is Bob Iacchino from the CME, Senior Market Strategist at LotusBrokerage.com, and still with us, our guest host, Andy Bro. So, Bob, I know these are volatile times. Is this a time for a retail investor to get involved, especially as we're really holding our breath before this big jobs report comes out?
Well, that's a really tough question. I think that the market lately has been the absolute description of a trader's market. That's why you're seeing some of the moves that you're seeing, the speed with which you're seeing them at. And a lot of the times, not true over the last 2 days, but a lot of times the reversal of those moves in toward the end of the day, especially before. We saw that before a long weekend here in the U.S. Last week. We saw it a little bit yesterday and toward the close. And the quiet you're seeing today, once again, showing a trader's market. So in terms of the retail investor getting in, I don't think this one individual jobs number is going to do the trick there. I think the problem with it is that late last week you heard around 350, and now you're hearing these whisper numbers just grow and grow and grow. And in my 17 years of doing this, that means that it's going to tend to disappoint regardless of where it comes in, unless it blows those whisper numbers out of the water, at least from a trading perspective, not necessarily from an economic perspective.
What are the whisper numbers you're hearing?
We're hearing as high as 750, 775 on some of these rumored numbers, and you saw people set up long, traders specifically set up long over the last day and a half, ever since the administration started saying that it was going to be a large number, a blowout number, as some of them said. And once again, those kind of things tend to muddy the waters a little bit. It's not that the number won't be strong and won't look good from an economic perspective, especially if we get that downtick in the unemployment rate, along with a good addition of non-farm payrolls. But those things traders tend to set up for that, and if the move doesn't continue in toward late in the day, around 11, 12 o'clock Eastern time, if that move doesn't continue, you'll see the exiting of trades as you've seen of late.
Bob, are we through the worst though of the May volatility or not?
I don't think we are, to be honest. I wish I could say that we were. We're seeing less and less volume on the bigger days, and we're seeing those trades stay on less and less. In other words, the duration of the trades has been shrinking quite dramatically. So I would want to say that we were. I'm kind of looking forward to the summer doldrums, because I think if the summer doldrums set in, we could see a slow, steady increase, because globally the numbers have been coming in at least a little bit better than expected the majority of the time. So you can see that slow, steady increase. But unfortunately, I think it's going to persist for most of June.
Let's bring Andy in on that. He's listening. And it's been very tough for hedge fund managers, because there hasn't been one trade, really. The problem with this volatility, there hasn't been one trade that you could pick on and could work out. What has been the fundamental? I mean, I've been trying to look at a lot of different fundamental causes. I couldn't work out whether it's China slowing down their economy, whether it really is the debt crisis. Where do we go from here?
If you look at it, the hedge fund managers, their big trade, a lot of them, has been just get along of China, get along of mining stocks. And they've been long on mining stocks for the first couple of months of the year, and then suddenly people say, my God, China's slowing down. Whether it is or not, it's impossible to say. It's a bit like US government statistics. No one really quite believes them. And then the mining stocks, along with the Australian tax, have just absolutely been hammered. You know, Rio's went from nearly 40 quid to 28 pounds, and it's happened in the space of a week. So the volatility is such, and just as you've recovered from that, the banking shares, which have been very strong, suddenly Lloyds Bank goes from 70p to 55p, because people are now worried about contagion. They're worried about, are we going to have a double-dip recession? And so we've been driven by very, very short-term sort of factors. And why, we're hanging on this number at 130. Is it going to be 500,000? Is it going to be 750,000? Really, it'd be great to just sort of take a step back and just try and establish a trend rather than react immediately to what is happening on a minute-by-minute basis. But the market doesn't allow you to do that. So what we're trying to do, we're trying to say, right, okay, we think things are gradually getting better in certain places. There will be problems ahead, but actually paying the right price for a share because of the volatility is probably more important now than it's ever been.
Hey, Bob, this is Christine here. So where do you hide from all this volatility? Do we hide in gold then?
Well, we have been hiding in gold, haven't we? I don't know that there's any hiding other than cash and gold. And, my fear, if I could touch on something that Andy said, I've been listening to him all morning, and I think he's dead on about that sort of the short-term move isn't necessarily where the activity is going to be and where the activity is going to stay. I think from the retail investor's perspective, the plan over the last 10 years is really the only plan you can sustain. The mutual fund cash levels are at record lows, and if we continue to see these sort of fast up moves reverse as they've done lately, that's not going to keep this long-term trend sort of going up. Worst May that we've had in quite a long time, volatility to come again in June. So I'm not sure there's anywhere to hide other than cash. But in terms of the plan for the retail investor and the longer-term investor, I do believe the year is going to end up positive, and I think there's a chance it can end up positive double digits overall. But from a standpoint of what the traders are looking at and what's going to happen today, it really doesn't matter that much.
Yeah, I think in places to hide, I agree with you. Cash is probably the best place at the moment. Everyone talks about gold being a fantastic store of value, and you look at how much gold is actually mined each year, it is very low. So a bit of an increase in demand, and you've seen the price sort of spike up from here. Overall, if you look at the companies themselves are in a lot better shape than governments. Record sort of levels of cash on the balance sheet, good corporate earnings, margins have been at sort of record highs, and so shareholders are being rewarded for holding shares in terms of dividend increases. It's just the stock market has decided, well, actually, we're not quite sure what's going on, and we're going to sort of whack these share prices around. So if you're a retail investor, you're watching your wealth go up and down by a huge degree, and you've just got to say to yourself, right, okay, well, let's try and find a sensible basket of shares that we're happy to own at this price, and we'll put them away and not look at them for 3 years. I think is the only way to do it now.
Buy and hold.
Well, buy and hold for a while.
All right, Andy Bruff stays with us for the rest of the hour as our guest host. Bob Iaccino from the CME stays with us as well.